Analysts are starting to get behind home building stocks, which is very crazy because that's an industry that I've been a super bull on for a long time. And that's what we're going to cover in this video. And you're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, and let's dive right into this. So a very interesting thing that's happening now is that analysts who have been previously sort of like negative on some of the securities that we've been buying up as they've been coming down are now starting to change their opinion, and now they're getting sort of bullish on these names. However, because we've been kind of like buying these things down as they've been out of favor, we're taking, all of that upside as these things swing back up. And so, of course, the one name that I'm talking about, which you also saw on the thumbnail, is Zillow. And let's see how the analysts are now talking about Zillow. So you can see Zillow stock actually surged early this year as it got an upgrade from an expected return of the housing growth. And, this is stuff that I was talking about, in 2020, early in 2021. There's just a huge secular growth trend behind home building. Now, does that mean that home builders recover magnificently from this downturn? In fact, I don't think so. I actually think 2023 is going to be a tough year for home builders. However, we don't model companies out on a one-year basis. We model them out on a perpetual basis. And so, the analyst is coming to say that, they're expressing confidence in the housing market, and they're expressing confidence that it could become more affordable. And really what they're saying is that home prices are going to come down. And I'm totally for that. Now, do I think home prices are going to come down materially? I don't know. We'll see how that plays out. But I still think 2023 is going to be a tough year. And that's kind of what they're saying. They're saying that, or at least this analyst is saying that they predict a bottom to the housing market this year. And who is that? That is Bank of America security analyst Curtis Nagel. And so he actually raised his price target to 42 from 2022. And you guys have been known on this channel that like $22 per share is just a nuts price target. And really what you're saying there is that the company will never recover into perpetuity. Now, I understand that analysts have a one-year price target. I get that. But this is where I just feel like you really shouldn't pay attention to analyst price targets. Pay more attention to their research. And, people who subscribe to the Patreon, I also say that to them as well. Do not pay much attention to the price target that I put on a company or the multiple that I'm using. Really, the value of the Patreon is the buildup for the modeling and sort of like how I'm modeling the P&L out, and then, how does that fracture down into like cash flow, etc. That's really where the value is. Really, it's like how am I forecasting out the segments, and how am I addressing, certain like one-off type situations. For example, with Zillow, they got rid of their iBuying segment. Well, how do you model out the company without the iBuying segment, considering the fact that the comps from the historical financials are no longer relevant? And so, that's why joining the Patreon and getting access to that model will help you sort of like model that out. And so you can forecast out a valuation yourself. But the point that I want to make is that $22 per share is effectively saying that the company's never going to recover. And I just don't see that ever happening. And so I've always been around that $40, $50 per share valuation for Zillow. And, I don't really disclose the positions that I purchase. And part of that is just I don't want you guys to follow into building out your portfolios the way that I'm building them up. But Zillow is a company that I ended up buying, I think, twice last year. And I think that's right. And I did that via cash secured puts. And so, of course, both of these cash secured puts are sort of out of the money at this point because the share price has gone up considerably. So, I'm not going to reap the benefits of that huge swing upwards. However, both cash secured puts were sold with premiums that were 20% annualized with 1 year out in term. And so, these are pretty respectable rates of return for a conviction bet like Zillow, while also being protected on the downside. And that's kind of the way that I was investing in 2022. That was largely the theme. In 2023, we'll see how it plays out. The stock market's a little bit pricey right now, so I might continue to do the same as what I was doing in 2022. But if things come down, I might just be flat out buying securities. And let's just go into this a little bit more. So, they're saying that the rate on the 30-year mortgage climbed to around 7% or 6.5%, which, it really means that homes are less affordable. And I get that. And so that's why you're seeing mortgage applications at the end of 2022 are at their lowest level since 1996. This makes a lot of sense. But of course, like I said, when you value out a company, it's not about what's happening today. It's what's going to be expected to happen in the future. And when I say future, I mean, 5, 10, 20 years out. Zillow is a company where, if I was given the securities securities at the price at which I was willing to own them at, in other words, the strike price on the cash secured puts, I'm willing to own that forever. And I think, the strike price, the net purchase price was well under $20. So, if you're going to give me Zillow for $15 per share, I'll buy up the whole company if I had enough cash, and so, several analysts have been uncertain about where the company would be in the near term. It doesn't matter where it's going to be in the near term. Who cares? But you got 27 analysts covering it. 11 say it's a buy, 13 say it's a hold, and 3 have it as a sell. Fine, whatever. Like, their opinions are their opinions, and they're all right so long as they did the research and, they came to that conclusion reasonably. And so Rich Barton, a lot of you guys really like Rich Barton, and in fact, I really like him too. Just because a CEO makes a mistake, like he did in the iBuying segment, doesn't necessarily mean that he's a horrible CEO. The question is, can they fess up to it and come up with a plan to move forward? And if if I accept that plan, I think it's reasonable, then I'll continue to invest in it. And if you don't, then you don't have to, And so we're not immune to the impacts of a choppy housing market, of course. And he added that the rapid volatility has impacted their funnel as our connections decline while buyers decide whether they want to be on or off the sidelines in this current market. And so, he's painting a pretty tough picture, and that could be the reason why analysts are not so confident on the security. And if you expect a company to have weaker comps in 2023, you're probably going to get it. I think Zillow is probably not going to do as well in 2023. And so when I forecast out the business, I do just that. I forecast out a rougher experience in 2023, and then, maybe a pause in 2024, and then a little bit of a pickup in 2025. But one thing that you guys are noticing in every one of my models is I am not forecasting a return to 2021 or even 2020 economics. I think those are really, really Federal Reserve juiced boom years, and you're just not going to see that. But I found that, especially on the value investing space here on YouTube, a lot of people were using those growth rates and valuing those growth rates out into perpetuity, and they ran into a lot of trouble. Anybody who was pushing those tech names, especially those SPAC names, they got burned. And so he went on to say, while mortgage applications are currently at the lowest levels, year-over-year declines appear to have stabilized in the down 40% range over the past 3 months. And so it gives them more confidence that unless mortgage rates materially spike over the next several quarters, volume declines should improve. Now, I do want to see Zillow's year-end results before I really am confident in forecasting them out, but I just want to point out that, the IMT segment actually has grown on a 9-month over 9-month basis. However, you can see that in the last quarter, it actually went backwards. And so how should we forecast this out? I might be forecasting this out at like a 0% growth year over year, but I might actually bring it back to maybe like a 5% decline. Mortgages, of course, you can see that in the last quarter, they just went nowhere. But notice that mortgages is a much smaller business to the overall business. And so the one thing that I found a little bit interesting is that the rentals business actually accelerated in the last quarter. So that's interesting, and just sort of like a read through on how we forecasted that out. Right now, I'm just forecasting these segments out at this level, but if they're going to continue providing this sort of information, I'll break it out even further and break out the IMT segment into these other segments. And so here you can see the model that the Patreons get access to at that lower tier of the Patreon. And if you want to join us on an epic live presentation, you can join us at that higher tier. Now, notice that I'm forecasting the IMT segment just to grow it at 0% for this year. Now, I do expect a bit of a recovery in the amount of 10% in 2023. But, now that I'm thinking about it a little bit more, I might actually bring that down. And so, by the time you guys get into the model, this might just be like a 5%, probably not more than that. And then I'll probably taper this down to 10% and just keep it 10% thereafter. And so I'll probably do that, just bring my expectation down a little bit. I was hoping for more of a bottom in 2022, I think, when I was originally modeling this out, but I think this thing drags on for a little bit longer. I think 2022 was a lot stronger than I actually anticipated, despite the fact that the market went down as much as it did. I thought things were going to be a lot worse in 2022, and so we'll taper this down a little bit. And then the mortgages segment, I think I got this one bang on. I expected it to decline significantly. It has. I don't expect it to go anywhere in 2023, and then I see a small rebound in 2024, and then it probably just goes back out at the 15% and then 10% thereafter. But this might be a little bit optimistic as well. I want you guys to let me know how you would forecast it out. So I'm telling you guys right now, this is not how I would forecast it out. I'd probably bring this down as well. But I want to know what you guys think in terms of how you would forecast this company out. And let me know in the comments below what your thoughts are on the IMT segment. Now, the one thing that I would point out with the IMT segment is that, they continue to build out that super app. And so they're just going to have greater and greater opportunities for revenue growth once things come back. And so that's why I'm still sort of optimistic on the future with the IMT segment. Now, revenue growth is one thing, but profitability is another. Now, they give out segment profits that essentially tie to net income. And so notice that I have significantly brought down the IMT profitability, and so I brought it down to 12.5%. So even if I'm a little bit excessive on the top line, you can see that I'm taking it off from the bottom line. Now, I do believe that profitability remains suppressed in 2023. So even though they increase revenues, they're never going to get back to these high profit levels in the IMT segment in the short term. I think they give up some profitability just to make the top line continue to grow. So we'll see how that plays out. And then profitability slowly comes back in the IMT segment. So, I might be a little bit optimistic on the top line, and I might be a little bit pessimistic on the bottom line. So I think this is correct, though. With the mortgages segment, I'm essentially saying that they're losing money in 2022, which makes a lot of sense. And then they're not making any money in 2023 despite a stabilization or a slight rebound. And then they're only making that 3% margin thereafter. And so we'll see how that plays out. But once again, and the corporate burn is around 1.5%. You guys let me know what you think about the segment profitabilities for Zillow. Am I getting this right, or am I missing something? And so overall, as it stands, I'm valuing the company at around $31. Add the excess capital per share. Now, this is why I want to see their Q4 results before I have a better idea how to value out the company. I kind of want to just sort of like dial in this excess capital per share amount. I feel like there's a little bit of uncertainty there as they wind down their iBuying segment, and so I just want a little bit more there. Now, I'm valuing the company at around $40 per share. The current share price is $42 per share, so this opportunity is largely gone. It was cheaper earlier in this year, but notice that the analysts are now jumping on it when I felt like they probably should have jumped on it when the share price was a lot lower than it currently is. And this is what I mean about the share price running so much. So you can see that in the last 6 months, it's run 30%. And this is why the tracker is so cool to have, the Patreon tracker. And I'm not trying to sell you guys on this, but I love it. I use it every day, is because, when you start seeing these share prices come down and, you have a valuation, I'd probably had a valuation of around 40, maybe even a little bit higher because I just did bring it down. You see this company trading at $27 a share. Well, you're now in a situation where you could probably sell a $15 cash secured put with a 25% yield. And, if you get exercised on that, your net purchase price is $12 or whatever. It's probably not that lucrative. But the point I'm making is you can really snipe these things because the trackers lists the stocks in a way that, it shows the current share price compared to its intrinsic value. And so you just sort of see where things stack up. Now, of course, the tracker is not a buy or sell recommendation tool. It's just, an analysis of what my opinion is that the company's worth. And then, of course, ultimately it helps you build out your model, and then you decide if the company's worth more or less than what I think it's worth. Now, this is not the only situation where the analysts are back behind a beat up stock. You guys know on this channel that I've been a bull on Alibaba for a long time, and it looks like now the analysts have got back behind Alibaba. And if you missed that video where I talked about Morgan Stanley and Goldman Sachs now pumping Alibaba as their number one sort of conviction play, you can get to that video right here.